It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. For more, we're joined by Nadia Lovell, Chief Investment Officer and Chief Equity Strategist at UBS in New York. Nadia, we talked about the preference that UBS has for energy stocks in the market right now. You also like healthcare stocks, and that may be of particular interest to our viewers because while we have a very large energy sector in this country, we have a very small publicly traded healthcare sector. So when Canadian investors want exposure to healthcare, they very, very often have to look to the United States. Why do you like healthcare?
You know, that sector just checks a lot of important boxes in this current environment. You know, we have high inflation, slowing economic growth, and of course, heightened geopolitical risk. Historically, healthcare tends to outperform in this kind of environment. It has both those defensive and growth characteristics. It also has fairly stable earnings growth, innovation with secular growth, and discounted valuation. I mean, if you look at the earnings growth of healthcare over the last 20 years or so, it's the only sector really that's had positive earnings growth each year in the U.S. in and out of a recession. And so typically average earnings growth about 10%. So there's a stability of earnings that we think that investors are really looking for when the macro backdrop is really starting to call growth into question.
What about, is this a pandemic comeback story in Canada, and I'm sure in the United States, many non-essential procedures were delayed because hospitals were filled full of people being treated for COVID. As that situation recedes, do you see healthcare companies being busier serving their clients?
Absolutely. That's part of the story. We're seeing a recovery in surgical and medical procedures as the threat of COVID recedes. But I think it's beyond that. You know, it's also favorable demographic trends. So there's a cyclical aspect of it as the global economy really population ages. But also there's that persistency in the innovation in the space. We're seeing new drugs, you know, new devices, drug and healthcare services delivery system continue to progress and come to market. And we saw that in a mainstream way during the pandemic. You saw the swiftness and the effectiveness of the COVID vaccine, therapeutics and testing that really shined a light on the pace of innovation in the space. So, you know, we're looking forward to seeing new drugs to treat the growing diseases like Alzheimer's, new drugs and medical devices to combat diabetes, as well as cardiovascular disease and pipeline opportunities in more cancer treatments and gene therapy. So it's beyond just a COVID rebound.
What about political rhetoric around drug pricing? Oftentimes, as U.S. elections near, and the November elections aren't too far away, there are, on the Democratic side of the so-called aisle, there are pledges to curb increases in drug prices, and that can be a concern for investors.
Yes, I mean, you're quoting what happened back in 2015 when there was vows by the U.S. presidential candidates to really bring down drug prices. And while there's been many proposals since, you've had, you know, proposals to re-import drugs from Canada back into the U.S. and linking U.S. drug prices to our international index and, you know, the government negotiated drug prices. No progress has been really made. And so we don't think that even under the current administration, there's been a lot of stalling. We don't think that there's going to be any major drug pricing reform ahead of the midterm election. And so we think that that could be an opportunity for the valuation overhang that's been under the space to start to relieve itself. I mean, the sector is trading under 16 times forward price to earnings. That's about a 12% discount to the market versus historically it's traded at a premium. And we think that it's just much cheaper than the other defensive peers like utilities and consumer staples. And so hopefully we'll have some clarity and that will help a re-rating, particularly in pharma.
What about the medical device makers? There is a lot of innovation going on in that sector with robotic-style technology that could really revolutionize the way some patients are treated.
Absolutely. I mean, that's a part of healthcare that we particularly like, the medical equipment and supplies and life sciences and tool. I mean, as we talked about earlier, medical equipment should really benefit from the recovery and procedure volumes, the innovation that we're seeing in robotics helping for less invasive medical procedures and faster recovery time. That ultimately saves the government as well as consumers on medical costs. And so a lot of exciting things happening in that area. we also think that, within life science tools, that area should continue to benefit from government and industry spending to drive the innovation within the broader space. And I would say also highlight pharma, because there are selective companies within pharma that also looks really good from a pipeline standpoint.
And what about biotech companies, the smaller companies that take a lot of risk in developing new drugs?
Those companies, we've seen a massive re-rating downward over the last 6 to 12 months or so. We would prefer select opportunities within those smaller healthcare companies, biotech companies. I think that you really have to take a managed approach there. There are a lot of innovation happening in gene therapy within those companies, and so there's select opportunities there. I would prefer to play it in this environment a little bit more through large cap biotech, which are trading at steep discount valuation, and also those companies that have good pipelines that are able to manage through upcoming drug patent expirations. But within small cap biotech, a managed way is a better approach.
Okay, you like energy, you like healthcare. Your least preferred sector is consumer staples. Why don't we finish there?
Yeah, consumer staples, obviously, as I talked about earlier, the premium valuation within the space does give us some pause. The sector also has a high exposure to high input costs. We talked about earlier, energy prices, all of these byproducts into things like packaging and resin. And so consumer staples are facing those higher costs. The lower end consumers also facing higher inflationary pressure, and that could cause them to trade down to more private labels. And additionally, this is a sector that generates a good portion of its revenues outside of the United States, where we're all seeing some slowdown and also facing some headwinds from the stronger dollar.
Nadia Lovell, Chief Investment Officer and Senior Equity Strategist at UBS. Thank you so much for joining us with your insights this morning.